What's up everyone, my name is Ale and welcome to My World of Finance. Today we're talking about the three stocks that I'm watching in the month of July 2018. Now these are actually the three largest publicly traded companies in the stock market, and of course they are very trendy, but the reason that I chose these three is because they are reporting earnings in the month of July, and we all know that each one of these stocks can individually affect the entire stock market, and these stocks are Amazon, Apple, and Google. So with all that being said, let's get started.
Well folks, it's time to kick it old school, so you can feel cool. Yeah.
Okay, starting with Amazon, I've actually made a lot of videos on Amazon in the past, and I'll have those linked in the description below. So if you want to see more in-depth details on Amazon, make sure you check out those videos. But let's go ahead and start with Amazon's stock. Now, as of this recording, Amazon is priced at over $1,700 a share, and in 1 year, they are up 75%. Year to date, they're up around 50%, and they have an insanely high PE ratio at over 200. But even if all that sounds scary, you have to understand that Amazon doesn't really play by the rules. Even when they were priced at around $1,000 a share, I was predicting that they'd hit $2,000 sometime in 2019. And as long as we don't see a major correction or stock market crash, then I'm still predicting that they'll hit 2,000 probably by 2019 or sometime in 2019. But when you look at Amazon's PS ratio, you see that it's a lot more reasonable at around 3.2. And the reason for that is because Amazon generates a ton of revenue, but what they do is they reinvest that revenue to grow even further and to dominate against the competition. But even this they've been improving on. You see, when you look at Amazon's net income, which is the furthest deduction from gross profit and operating profit to see how a company is doing overall, you can see that Amazon has been improving every single year. In 2014, their net income was at negative $241 million, and in 2015, it rose to positive $596 million. In 2016, it rose to over $2 billion, and in 2017, it rose to over $3 billion. Now, if you ask me to look at Amazon's balance sheet, well, yeah, it's not going to be that great. Their cash to accounts payable and long-term debt in 2017 is probably around a 1 to 2.5 or 1 to 3 ratio. So their cash to debt ratio isn't going to be the greatest, but that's not really my biggest concern when looking at Amazon, considering how many markets they operate in and how many markets they are expanding to. You also have to understand that it takes money to make money, and that's usually how Amazon operates. Now, Amazon is the second largest publicly traded company after Apple, and I'm not going to waste time looking at them at a deep analytical level. You'll probably just find them being incredibly overbought. But the real question is, what do you do if you are not in Amazon or if you're already in Amazon? If you're out, do you stay out and maybe wait for a correction or a better point to entry? And if you're already in, do you stay in and maybe ride the wave even further, or do you cash in some of your profits? These are some of the questions that still remain. My personal opinion is that there are three things to really look at with Amazon, one of those being subscription services. I think that the longer you've had their subscription services, things like Amazon Prime, the less likely you're going to be to cancel because of the deep investment you've already made into that subscription. So I see Amazon having a strong retention rate, even though they've consistently raised prices. So I also see numbers and profits continue to improve as subscription services not only retain customers, but also reach other consumers as well. I also see increased growth and profitability coming from Amazon cloud services and advertising. When looking at Amazon Web Services, they've been improving on a consistent basis and always helping to improve profitability. And when looking at advertising, we know that Amazon has been continuously trying to get a better foothold into the advertising market, going up against Google and Facebook. And we know that Google and Facebook really dominate online advertising, but if Amazon can really get their foot in the door and start taking some of that market share, we could see numbers improve as well. Now, lastly, I also think that Amazon still has room to grow even in their retail segment. Now, looking at Amazon retail, maybe we'll see numbers slow down domestically, but looking at internationally, I think there are many international markets that Amazon can still tap into. And so as we continuously see Amazon tapping into some of those international markets, I think they could still even grow their retail segment as well. All right, next up is Apple, and this is the largest publicly traded company out there, ticker symbol AAPL. According to Robinhood, they'll be reporting on the 31st. Some other websites are saying the 24th. Either way, they are currently priced at around $188 per share, and while their stock hasn't been performing as well as Amazon, they're still doing very well. In 1 year, they are up 32%, and year to date, they are up around 11%. Now, they also have a PE ratio that is pretty reasonable at around 18, and they do have a dividend yield of 1.5. Now, looking at their balance sheet, there isn't anything really too impressive. They do have a higher asset to liability ratio, but their cash is only at $20 billion, while long-term debt alone is almost at 100 billion, so it's not really anything to brag about. Now, while I've never personally been too bullish on Apple, I've been a little more neutral on Apple, but they have proven me wrong many times, and in 2016, they reported a very impressive $45 billion net income, and in 2017 that rose to 48 billion, so very impressive there. And while I still hold my opinion that iPhones are insanely overpriced, we know that the last overly hyped iPhone X didn't really sell as much as they were expecting, and so rumors are coming out that they are now considering dropping prices of the next gen iPhone. Rumors recently surfaced from KGI Securities that Apple will be launching several different models of their next gen iPhones, and they'll be starting at a price of $550, whereas the previous gen, the iPhone 8, had a starting price of $700, so that's a considerable drop there in price. Now, this may turn out to be a brilliant move because it may not only convince current iPhone users to upgrade, considering that the price is a little more reasonable, but it also helps them tap into international markets like China, because it now provides a more affordable iPhone, whereas these international markets are oftentimes dominated by cheap Android phones. So a $550 iPhone, while that's still not really cheap, it is a little more mid-tier priced and can maybe sway some consumers to go for iOS. And while I have seen a couple analysts predict low iPhone sales for this current quarter, I think that any dip in the stock price based on this quarter iPhone sales alone may actually end up being a blessing in disguise by providing a better entry point for the stock. Now, one thing to definitely pay attention to in this upcoming earnings is Apple's services. Their services alone brought in $9 billion in revenue in the previous quarter, and this was up 30% year over year. So this is a massive number and definitely something to keep an eye on. Seeing data center growth like that in a market that is dominated by giants like Amazon, Microsoft, and Google is definitely impressive. And if we continue to see strong numbers there, I think that Apple's stock will reflect the good news. Okay, and lastly, we're looking at Google, ticker symbol GOOGL or GOOG. And they are currently priced at around $1,100 per share or over that. And their PE ratio is at 50, which is pretty high. And they will be reporting earnings according to Robinhood on July 23rd. Now, this one is a stock that is a little bit easier for me to report on because I've been bullish on them for a long time. I've held their stock for a long time, and I've always just been very positive on Google, so I definitely have a lot of opinions on Google. Not only do they control 90% of the internet search market, but they also dominate online advertising with Facebook without much other competition or serious threats, except for maybe Amazon. Now, Facebook is definitely a concern there in online advertising, as they control around 21% of online advertising in the US, but Google still dominates with over 42%. And with the recent investment from Google in the second largest Chinese online retailer, JD.com, by purchasing 27 million shares priced at around $550 million, you can definitely expect some major growth as the two will be collaborating on online retail solutions across the world, probably starting with the US, Southeast Asia, and Europe. And Google also has a tremendous presence in autonomous driving. They also control YouTube, which has 1.8 billion people using it every single month, which is very close to Facebook's 2 billion. And they also control Google Maps, and who can forget Apple's biggest smartphone operating system rival, Android. And with smartphone loyalty rates at all-time highs and Apple being at a very impressive 88%, Google still takes the win, with Android having a loyalty rate at around 91%. And when looking at phones shipped in 2017, iOS only had 15% of that market, while Android dominated at a very impressive 85%. And yes, this does mean that Apple and iPhone can technically steal more market share from Google and Android, but I think it's still better to just start off with the lead from the get-go. And thanks to all of these assets, we saw revenue in 2017 jump 23% year over year, and many analysts are expecting similar performance in 2018. Now, going into this earnings, like I mentioned, I'm very bullish on Google and I'm expecting great things, but as always, anything can happen, so we'll have to just wait and see. But either way, I think that Google is still a very good long-term investment. But who cares what I think? It matters what you guys think. So make sure you leave a comment down below. Let me know how you feel about these three stocks. I know they're very trendy. I'll try to have more random stocks next month, but the reason I had to go with these is because they're the three largest companies. They're reporting earnings. We know individually they can really affect the stock market, so I think it's very important to keep an eye on these, especially in the month of July. So anyway, thank you so much for watching. If you could please do me a favor, support the channel by hitting the like button. Thank you so much for watching. I hope you all have a wonderful, beautiful day, and you take care. Bye.